When to trade? One of the advantages of Forex trading is that it is a market open 24 hours a day, every weekday. This means you can potentially trade at any time of the day. But there are certain periods that can significantly reduce your risk and improve profitability. This strategy is built around day trading. Ideally, we aim to have our trades closed by the end of each trading day to avoid increased spreads, swap rates, and honestly, we just want to go to sleep with peace of mind without worrying about our trades on the market. In Forex trading, the end of the day is represented by the end of the New York session. You can check session times here on forexmarkethours.com, and you can also adjust them to your local time zone. When the New York session ends, swaps are calculated, spreads widen, and the volatility is very low, with very small movements on the market. So ideally, you would like to avoid carrying your trades over the end of the New York session. That is why my recommendation is avoid opening new positions between the end of the London session and the start of the Tokyo session. Between the end of the London session and the end of the New York session, you risk to open positions that don't have enough time to close before the end of the New York session. While between the end of the New York session and the beginning of the Tokyo session, you have very bad trading conditions with wide spreads and little volatility. So again, my recommendation is to avoid opening new positions between the end of the London session and the start of the Tokyo session. Note that this recommendation refers strictly to opening new positions. During this time, you can and you should continue to manage your existing positions. If the strategy requires you to add to an existing position, it's perfectly fine. An exception to all of this is trading on Friday. This is because trades that you don't close on Friday go over the weekend and you face the risk of weekend gaps. A gap happens when the market opens on Monday at a significantly different price compared to where it closed on Friday. This can mainly happen due to unexpected news or geopolitical events over the weekend, which cause large and unpredictable moves that are reflected in the price only when the market reopens on Monday. To minimize this risk, when you trade on Friday, I recommend avoiding opening new positions after the first hour of the New York session. So after the first hour of the New York session, only manage your existing trades. Now, one question you might have is, what if I still have open positions at the end of the day or at the end of the week? If you have positions open at the end of the New York session, simply leave them open. You will either pay or receive the swap interest, while spread widening won't impact your open trades, as we don't use any hard stop loss that can be hit by a larger spread. If you need to go to sleep, what I usually do is to close my trades manually if they're small and hovering around break-even. If I have a bigger position, I just set the next two limit orders and then I go to sleep. The next day, I reassess the situation and check the status of my trades. You might be surprised how many times I go to sleep and then wake up with the trades that have barely moved. Occasionally, when I have a very big position, I pull an all-nighter and manage my trades until the situation gets more under control. However, in more than 2 years trading with this strategy, it only happened twice. Alternatively, you can set price alerts that act as an alarm clock, waking you only if the price makes a significant move. A different situation is when your positions are not closed by the end of Friday's New York session. Going through the weekend with your trades is much more risky than carrying them overnight. So if you still have multiple open trades at the end of Friday's New York session, consider reducing your exposure. A practical rule of thumb is, if you have more than 10 open trades, consider closing half of them. You can always reopen these trades the following week if the price is favorable. Now, remember, these are just my recommendations. They are not rigid rules. Effective risk management comes with practice and experience. Over time, you will naturally develop your own guidelines tailored specifically to your trading style and risk tolerance. Consider my suggestions as a solid starting point, then gradually adapt and refine them as you gain confidence and familiarity with the strategy.